and thank you for coming to this morning's webinar. This morning's webinar is focusing on knowing your numbers and getting them working for you. So I'm going to be your host today. My name is Chris Wilson. I'm a director at Benson Wood & Co. And I'll try and make this as exciting and as pleasant as I can for you this morning. Just want to thank you all for taking your time out to join us and to listen and to me this morning. Just a couple of thoughts to start with. I just wanted to say that Benson Wood & Co. over the last couple of years, we decided that our main kind of focus areas, our values, are centred around clarity, certainty, and trust. Clarity, being clear about where you're going and what you want to achieve. Certainty, knowing where you are and how you're going to get where you want to be. And trust, mutual trust between us and our clients to help them and you achieve their goals. So today's webinar is akin to that, knowing your numbers to give you more certainty. Before I start properly, another wee thought for the session is this wee quote from Jack Lew: "A budget is not just a collection of numbers, but an expression of our values and aspiration." Thinking that what you're budgeting for is basically you setting out of what's important to you and how you want to get there. So hopefully you've all updated your budgets and forecasts to reflect the challenges of COVID-19 that we're coming out of, and also the new challenges that we're facing this year, particularly with the war in Ukraine, cost of living, and all these other factors. But you want to express what you want to achieve over the next 12 months. Now it's time to make sure that you can understand, monitor, and measure what you've set in those budgets and forecasts. We want to use this webinar to demystify the most common reports that you might be seeing weekly, monthly, quarterly, and even on an annual basis, so you can interpret that and be more in control of your business performance. So over the next wee while, there's a few areas we'll cover, as I've set out in the agenda there. We'll cover the importance of knowing your numbers, an overview of different some of what we talk about might sound like a foreign language, just completely off the wall. Don't worry about that at all. Our aim is to help you understand these things as best we can. So please put any questions in the panel at any time throughout this webinar, and we'll answer you at the end. Why you need to know your numbers. Number one, they tell the story of your business, allowing you to interpret the results of your business activity. Following from that, this helps you to identify the symptoms versus the root causes. For example, if your gross profit is declining, root cause of that may be ineffective pricing or work having to be redone but not recharged, or possible wastage of stock. It's the timing of these decisions that could be more key as well. And finally, point 6, knowledge is power. The more you know about your business, the better your business will be. We'll be reviewing each of these key reports to help you understand what you can learn from them. We'll work through an example to show key learnings to look out for in your reports. So it's a made-up company called Foodsco that will work through for the examples that will hopefully illustrate that more easily for you. So firstly, we'll look at your trading account. Your trading account tracks your sales, variable costs and gross profit to calculate the return you're achieving before deducting your fixed overhead costs. The gross profit percentage indicates whether your margins are improving or deteriorating. Sorry about that. You can track your results across different divisions or product lines by using multiple trading accounts. For example, if you have regional locations, having a trading account for each location allows you to track how each is performing. A lot of people will be using cloud products such as Xero. To do that in Xero, we use things called tracking categories, and we can run these reports per tracking categories. And we can talk about that in more detail later too. Small adjustments to items in your trading account can have a huge impact on your overall results, which we'll demonstrate now. So this is the trading account of Foodsco. As you can see, they had sales of just over 1 million, cost of sales of 318,000. The direct costs, right down the page, was 450,000, giving them a gross surplus, a gross profit, £248,749. And that is a gross profit percentage of 24%. In terms of one looking to improve this, let's say the company undertakes coaching with an accountant and implements strategies to increase their customer retention rate, resulting in a 10% increase in sales. They also work with their accountant to review their inventory process and reduce their cost of sales by 5%. The inventory process is centered around stock, how long you're holding stock in your production process. Further to that, they renegotiate their contract with their delivery provider, resulting in a 5% saving in their direct costs. As a result of these changes, you can see the differences here. The gross surplus has increased by £140,241, and the gross profit percentage has increased from 24% to 35%. Understanding your trading account allows you to identify areas where small improvements can have a big impact on the profitability of your business. In terms of that, if you think of just a small increase of either cost or sales price, it's scaled up by the amount of your productivity, and that can be really effective. Next, we'll look at your profit and loss account. This is also known as your income statement. It shows all your earnings and costs over the year, tracks the overall performance of your business. It matches your income expenses for the period with adjustments for timing differences. For example, sales have been made, but money hasn't yet come in yet. It's important to remember profit is not the same as cash. The profit shown in your profit and loss account includes non-cash expenses such as depreciation. You need to ensure that you've got sufficient profit to cover cash costs such as loan principal repayments, asset purchases and drawings. Your profit and loss account provides a framework to benchmark your results by using percentages or comparisons between years to compare your business performance to similar businesses. Businesses are generally valued using a multiplier of earnings. So your profit and loss account is a fundamental driver of the value of your business. The higher your earnings, the higher your value. Continuing on with Foods Co, we'll look at their profit and loss account. We've taken the gross profit from the trading account and we've listed all the expenses to calculate the net profit or loss. As you can see, the company is currently trading at a loss of over 113,000. Let's say the company undertakes a review of all their expenses with their accountant and identifies potential savings to be made to their insurances and rent. You contact the insurance broker and landlord and negotiate a 5% reduction for both expenses. You've saved £597 in insurance expenses and just under £3,000 in rent expenses. However, you'll notice that accountancy fees have gone up. Remember, in the previous example, the company had engaged their accountant for coaching and other services. But despite that, the overall net surplus has increased by 138,000, lost to 24,000 due to savings made. Therefore, worth the cost, if that's an investment cost for the ongoing improvement there. The next report we want to look at is your balance sheet. The balance sheet is also known as the statement of financial position. It provides a snapshot of your business's financial position at a specific point in time. It measures the net worth of your business, which is your assets minus your liabilities. It also shows if your business is solvent. If your liabilities are greater than your assets, then your business is insolvent and urgent action is needed to fix this. You can compare different periods to determine whether the business's net worth is increasing or decreasing between years and track the strength of your business. The stronger your balance sheet, i.e. the more solvent it is, the easier it will be for your business to survive a downturn. It also provides a basis to calculate key ratios such as debtor days, which measures how quickly you're being paid by your customers, and inventory days, which measures how long you're holding stock for. Continuing on with Foods Co, this is their balance sheet. As you can see, the company is currently insolvent. It has more liabilities than assets. Its working capital is also negative, as its current assets of 138,475 are less than current liabilities of 162,269. This means the company cannot pay its short-term debts from limited cash, debtors and stock it has in hand. Urgent action is required to remedy this. The business needs an injection of funds of at least 305,000, which may be in the form of share capital, i.e. issuing shares, or a shareholder or director loan. Assuming a company can resolve these urgent solvency issues, there are other areas for improvement too. Over the long term, the company can employ strategies to reduce their debtor days and inventory days to increase their cash flow. To calculate your debtor days, you divide your debtors by your sales and then multiply by 365. This is telling you how long it takes your customers to pay. Currently, this company's debtor days are 26 days. This means on average, it takes customers 26 days to pay their bills. If they updated their terms of trade and requested payment within 7 days and managed to reduce this by 5 days to 21 days, they would have an additional 13,944 available. To calculate inventory days, we divide the cost of sales, we divide inventory, i.e. stock, by cost of sales and multiply this by 365. This is telling you how long the business holds its stock before selling it. In other words, how long your cash is tied up in stock. This company holds its stock or inventory for 74 days. If they reviewed their inventory process and reduced the amount of inventory they have on hand, they might be able to improve their inventory days by 9 days. This would result in a cash flow boost of 7,860. So while cash flow gain of nearly 22,000 doesn't fix the solvency issue, it demonstrates how much cash could be saved with some help from their accountant and put these things in place. The next report is called the Statement of Changes in Equity. It shows what happens to the profits, i.e. they can be paid out as dividends or kept in the business as retained earnings to invest in the business for future. It represents the net worth or value of the company and is a key indicator of the company's financial health. It shows whether the company is solvent. Remember, if the company has more liabilities than assets, it's insolvent and the funds will need to be paid into the company. Staying with Foods Co, this is their statement of changes in equity. It can be seen that the company has accumulated losses for at least the last 3 years. This means the company has no retained earnings and is currently insolvent. There is no money to pay its dividends and no money to reinvest into the company to purchase new assets. The directors must take action now to increase the profitability of the company. The next report we're going to look at is the director's current account. The director's current account records all the funds introduced to the business by the directors, like capital putting in or monies taking out of the business as drawings. It can help you monitor your personal expenditure from the business. And for businesses with more than one director, it maintains a balance of the amount each director that's introduced or withdrawn to the business. It shows how much the business owes to each director. If the account is overdrawn, it means the director has taken out more than they have put in and now owes the money to the company. To put the account back into a positive balance, the director can repay the loan, or the company can increase its profit to pay a dividend or cover this with possible additional salary for the director. If your director's current account is overdrawn, it's important to get from your account. It's important to get in touch and get advice from your accountant soon to discuss the best possible options for you and your business. Another example of Foods Co, Mr. J. Doe is the director of Foods Co, and this is his director's current account. And it shows at the start of the period, the company owed Mr. Doe just over 29,000. In this year 2020, he's introduced 2,000 to the company and has taken out just over 9,000 in drawings and personal expenses. This means at the end of the period, the company now owes Mr. Doe just under 22,000. The amount owed by the company to Mr. Doe can only be repaid if the company is solvent and has the cash available to make the repayment. Because in our example, the company is insolvent, Mr. Doe will need to introduce more funds to the company to boost the trading, to make more profit in order that he can then repay that to himself. To ensure the company can repay this sum to Mr. Doe, a profit improvement strategy should be implemented so the company becomes profitable. For example, we demonstrated in the trading account and the profit and loss account examples of how small changes to processes could result in an improvement of 138,000. It's not sustainable for the directors to keep introducing money to the business if it's not profitable. The next report we're going to look at is the fixed asset register. Fixed asset register records a business's fixed assets, such as vehicles, plant and equipment, and facilities or premises, and spreads the cost of these assets over their useful life. It provides a basis for keeping track of the business's assets and can be a useful guide to determine when assets either need to be replaced and can budget for accordingly. It's also useful to have this records if you're ever thinking of selling the business, as it records their current value. The first column of the fixed asset register lists the names of all the fixed assets, with the second column listing the cost on the asset purchase statement. The next column shows the opening value of the asset at the start of the financial year. This is the cost less the closing accumulated depreciation from the previous period. That means that depreciation is mounted up to date. The next two columns show any purchases of new assets or disposals of old assets. A disposal can either mean that it's been sold outright, either there's been money received and it's now gone, or that the assets reached the end of its useful life and it no longer holds any value, i.e. the company's scrapped it. Then we have the depreciation rate and method of depreciation used. This company uses the reducing balance method of depreciation, which depreciates each asset by a constant percentage each year. The next column shows the depreciation for the period, followed by the closing accumulated depreciation. This is the amount the asset has been depreciated by since it was purchased. And finally, we have the closing net book value, showing the closing net book value of the asset. This is the value that will be recorded in the balance sheet under the fixed assets. So that sums up 6 of the key reports we should be producing and reviewing regularly. But regularly would mean quarterly, if not monthly. Each report tells a different story about your business and aids your decision making in a different way. If you have any questions about any of these reports, send them through now and we'll answer them shortly. In the meantime, we'll move on to understanding the difference between profit and cash. It's common for business owners to get frustrated that their bank account doesn't seem to reflect their profits. It's essential that you can understand the difference between profit and cash, and why a high profit doesn't necessarily result in more cash in your bank account. A profitable business can go out of business because it's starved of cash. A business running at a loss can survive because it either has access to funds from investors or financiers. In other words, cash flow is every business's reality, or as a lot of people say, cash is king. To demonstrate the difference between profit and cash, we're going to consider these items. Let's first think of VAT. VAT affects your cash balance, but not your profit. Now, you're going to pay that out of cash, but it doesn't come out of your profit. Loan repayments. The business has loaned money and has to pay this back. Again, that's paid back out of cash, doesn't affect your profit. However, the interest on those loans affects both your profit and your cash. It's an expense coming off your profit. The interest is adding on to the loan, it's getting deducted from cash. Asset purchases, again, only affecting cash, not your profit. It's not getting deducted as an expense. Asset sales. Sales in and of themselves only affects your cash balance. If there is a gain and loss of those sales, they'll come into your profit. And linked to assets is depreciation, again, which only affects your profit. It's not a cash item. Another useful way to look at the differences between profit and cash is using the business 101 cycle. First, owners need to invest money into the business, either by shares or loaning money to the business. This money can be used to purchase the assets needed to run the business initially, but we may need further finance to buy more assets, and therefore we may need to get some loan finance to top this up. The assets are then used to generate a profit, and you can increase your profit by growing your sales or your margins. But overhead expenses can drain your profit and result in a loss if they're not managed. The profit then gets turned into cash. Drains in your cash include slow collection of debtors, like those in excess of 60-90 days, high inventory days, loan repayments, tax repayments, and payments to suppliers. A business can achieve cash gains by collecting their debtors faster, decreasing their inventory days, negotiating longer payment terms with suppliers, and reducing their tax liabilities. The owners then take cash out of the business as drawings or personal loan repayments. The remaining cash can be reinvested into the business and purchase more assets to generate more income. The aim is to go through the cycle as quickly as possible to increase the return on your investment. After cash flow, business value is the next most important measure of business success. Part of knowing your numbers is understanding and measuring the drivers of your business value. These drivers might be your monthly recurring revenue, revenue growth, revenue per client, sales, or profit. These will be different for every business, but we can work with you to identify the drivers of your business value. To enhance the value of your business, you must first develop and implement a clear plan and document your organisation structure and roles within your business. Establishing cloud-based real-time reporting allows you to make better decisions, and reviewing and documenting your systems and processes ensures your business is running as efficiently as possible. Reducing the reliance on the owners of the business helps enhance the value, as it will be easier for new owners to take over if and when the business is sold. And finally, identifying and managing risks means these can be mitigated before they become an issue. We've seen throughout the webinar that profitability, cash flow, and value of your business all affect you personally. If your business isn't profitable and doesn't have much cash available, it won't be able to pay you to fund your desired lifestyle. There are a few other things you can do to help protect your assets, which I'll quickly run through now. Firstly, set up your business as a company to limit your personal liability. Second, consider who should be the director of your company and which assets are held personally by directors. Ensure that you have security over any money you lend to others at your company or other parties. Consider alternative ownership structures for high value assets. For example, if your business owns commercial premises you use, consider moving the ownership of the premises to a separate limited company or a separate body. Review the terms of trade and credit policies to ensure you only provide credit to customers who are likely to pay you. Review your insurances and make sure you have sufficient protection. For example, do you have business interruption insurance, indemnity insurance, and enough cover to ensure the impact on your business of any adverse effects is as minimal as possible. Personally, ensure you undertake financial planning to manage your personal wealth outside of the business. And finally, for the future, plan for the future. Do you have an up-to-date will, powers of attorney, and a clear plan for transferring your assets to the next generation, and also looking at succession as well? This isn't an exhaustive list. They're just some of the ways that you can protect both your business assets and personal assets. We can help you with identify specific ways you can protect your assets. And please feel free to contact us to discuss that. How does everything I've talked about so far today come together as best practice? Every best business should use 3 essential tools. 1, an annual business plan, or in these times, a business recovery plan. 2, an annual forecast. 3, probably more importantly, ongoing reporting and accountability. The reporting ensures the numbers you want to achieve in your plan and forecast are being measured. The accountability process, some form of coaching, using an independent coach who will hold you accountable works. Knowing your numbers is just the beginning, as it allows you to improve them and ultimately achieve your goals for the business. So where to from here in these challenging times? My aim is to help you take what you've learned today and implement some positive change in your business. Now it's time for you to decide what you're going to do. Best thing to do is take a few minutes after the webinar and write down 3 key points or actions that will add value to your business. As you see, these might be minimal, especially if you look at your trading account in terms of what you're selling for, what you're buying for. These small changes can make a big difference. And subsequent to that, everything else we've discussed too. What's the main problems that you're experiencing in your business? Identify these problems and use them as an opportunity to create a project to fix them. We always say, don't see the problem, see the opportunity. The worst thing you can do is nothing, and that should never be an option. So now it's up to you what you should be doing as best practice in your business. And here's how we can help you. Firstly, we can offer you a free complimentary meeting. Please get in touch via the panel or through the email address that I'll bring up at the end. All we would ask you to do in this is complete a short form and some questions so that we can make the most of that meeting for you. Secondly, if you don't currently have a business plan or a business recovery plan, we can help you develop one. We can also do an updated cash flow forecast to reflect the ongoing impact of COVID and the situation in Ukraine. For those who need to be held accountable to complete your actions, we have a range of coaching options, depends on the frequency of the issue. And lastly, we can help you prepare management reports each month, each quarter, and review them with you each month so we can look for areas of improvement, even areas of risk, so that we can catch these early for you before they could become an issue down the line. It may be difficult to commit to spending more money right now. All of these services include an assessment as to how you can improve your profitability and cash flow, so there will be a great return on investment for this process over time. For the short term, we have different payment options available, so please don't let cost be a barrier. Get in touch and we can work together to come to an arrangement that we can manage. We'll go through what you might need, we'll work out a proposal, but we'll only do it if it's right for you, if there's going to be benefit for the company to improve. We want you to improve the business as quickly as you can. It's all about getting to your ultimate achievements. What do you want from the business? And how can we help you get you there? What we've discussed today in this webinar is general in nature and certainly not a substitute for specific tailored advice and support, because everyone's different, every business is different. By working with you one-on-one, we'll be able to identify the most important actions to take you to where you want to be, so that you can help achieve your results of where you want to go. With that, I would like to hand over to Joe, managing our panel, to see if there's any questions we have from our listeners. One question came in: what is the difference between annual accounts and accounts that can be produced throughout the year? Now, in my view, annual accounts is like an overall assessment of how the business has performed during the year. Certain things may even out and you might make a good profit at the end of the year. Whereas if you look at more regular monthly, quarterly management accounts, these are more like an ongoing assessment, like a kind of health check to monitor any issues before they become major issues. So with no other forthcoming questions just now, I just want to say thank you for either tuning in and watching live just now, or if you're watching the recording later on, thanks for taking the time to go through this. If there's anything we can do to help, if there's anything you've maybe found confusing or you want more information on, please do not hesitate to get in touch with either myself or any of the team. If you come through our email at mail@benson-wood.co.uk or call the office on 01236 756 161, we're more than happy to have that chat with you and hopefully arrange that free complimentary review with you as well. So thank you everyone again for your time today. Goodbye.